My 44 years of experience to help you manage your portfolios and protect your wealth. Remember to subscribe, like, and share these videos. In tonight's video, I will cover my expectations for the coming week, but I'm going to go in depth on the long-term trends in all the primary markets that I cover normally and will include NVIDIA. Let's get into tonight's video. Well, welcome everyone. While the room's filling up, we'll talk a little bit about some of the expectations as I come into this week. And we've got CPI and PPI coming out. Just looking at some of the folks in questions, I know that the way that I start the videos now, we're going to be covering all of the primary markets I always cover, including I'm going to throw an NVIDIA review as well. But we've got CPI, PPI coming out. I've been kind of rattling on. Those of you that don't get the Substack, I'm going to do a quick advertisement. Get the Substack. That will do absolute wonders for your investing. I put a lot of time into it. All my micro daily analysis is there. It's $8 a month right now, so don't miss out on that. And there's, I think, well over like 2,100 of you that are subscribed now, so I appreciate that. I think it should be 15,000, so tell your friends. But it's a quick read I do every night. So let's get back into the video. My expectations for CPI and PPI, I've been rattling on about this concept that I believe that we're going to see a bounce in inflation. And this is my belief. We'll see if it happens. But this is the thing about these reports. We're always looking in the rearview mirror. And so the report that we're getting this week, those two reports are for last month. So we're always looking in the rearview mirror. My bounce in the inflation numbers will probably happen in August, September. So we'll get those reports in September and October as we get closer to the election. And I think they will start to come in a bit hotter than what we're going to see now. I don't expect any big surprises out of these reports this week, so I don't see them being material. And this week is very light outside of the CPI and PPI. They're substantial reports. We've got the typical claims and looking and continuing claims is pretty much it. I don't think there's much more that I noted that was even worth talking about. So from that standpoint, I think what we'll get, the best way to put this, I think it's going to be a continuation week on the upside. I know we're printing down just a little bit here, but the patterns that you're going to see are pretty big. And my plan is to focus on, I'm going to go all the way out on the appropriate markets on the S&P cash. I'll go out to a quarterly, and I'll go quarterly, monthly, weekly, probably do daily there, and then I'll do longer term stuff on all the other markets, because this is kind of the halftime report. This is really, even though June was halftime, I look at it like, okay, we've got a sense of how this third quarter is starting, and we're starting to get a little bit of a feel for what the expectations are. And we're still seeing, in my opinion, just some crazy numbers. We continue to see these bids coming into markets. I don't really have anything else to talk about there, but let's go into and talk a little bit about the longer term trends that we're going to cover here in a minute. My general feeling is that the bullishness that we've seen, and if you have read the Substack, you already know this, is that my expectation is that probably into September, maybe all the way into October, these trends are going to continue. I'm going to show you in a minute. We're going to go through the WaveTech database here in just a minute. And I'm really excited. I'm working on a project that I'm going to be rolling out here probably within the next, I'm hoping, 2 to 4 weeks that is going to be a very substantial offering that I'm doing, and you'll hear all about it when it's ready. But the bottom line is what we're seeing going forward is still that forward-looking element. So let's go ahead. I'm going to bring up the database. Let's get into that, and then we'll get right into the dialogue on the markets. All right, so this is the basic viewpoint of the markets. I'm going to take you over to the overview first before we get in. I wish there was a way for me to zoom in and out of some of these numbers, but you'll have to bear with me. So I have been talking about this for a while, actually, and I've been talking about the intermediate database backing off of this 60% bullish range and coming back into maybe 58, 52, just some more substantial rotation. None of that has happened. And I've been talking about it for maybe 2 months now. And the scenario that keeps happening is just a rotation happening. Now, we did see a substantial amount of buy signals you'll see here on the short-term database, but on the intermediate, we're stuck at 61.85. I didn't total this up, so I'm going to do a rough total of about 300 and let's say 315, 320 buys versus 100 or 220 exits. So we have a net positive again on this rotation. There were quite a few. There were 1,300 new buys versus about 400, almost 80 or so sell signals. So we had almost a 3-to-1 ratio on the short-term ratio. Let's take a quick look at that, and then I'll summarize what we're looking at here. So we're now up to 54.6%. And we still, one of the things I've been talking about on Substack is that my expectation is that we'd see more traction coming in on from the shorter term sectors, and we're not getting that. We're stuck with these. There's actually 4 sectors that are long now: consumer non-cyclical, financial, healthcare, and services, and they're all in the green. So we continue to just see this very minimal rotation, and I'm going to go back now to the weekly just to talk about that. And let me go off screen here just so you can see the full thing. Is what we're seeing here is the same 6 sectors are long on the intermediate database: conglomerates, non-cyclical, financial, healthcare, services, and utilities. It's interesting, basic materials, capital goods. We did get a new sell signal, consumer cyclical, and that's one of the that kind of removed off of the list. So we actually are seeing a bit of a contraction from the standpoint of the number of sectors that are long. So just to summarize this, is what we're really seeing on the database is a little bit of a contraction, which you should think about this. This whole thing started last October. This isn't this year thing. We really started bottoming, seeing a positive, the traction coming in October, November, and it just went on from there. So that rotation that started then has kind of rotated. We were up to, I believe, 8 out of the 11 sectors long. Now we're getting it back, and we're seeing consumer cyclical, but it was negative 7.5%. It was not, that was not actually getting the traction. There was some momentum there that was picked up, and the patterns that were picked up suggested that we would see some momentum on that sector, but nothing came into play. So we continue to have a narrow range, and I know everybody on the internet tells you there's 8 stocks that are driving the markets. I see it a little different. Just coming back here, as what we've got 9,312 stocks that are trending. There's some trends that are huge trends that are in the background that nobody's talking about, because everybody just looks at indexes and then they look at what's driving the index. And it's true, we do have the Magnificent Seven driving a lot of the percent returns that we've seen this year, but it's not everything. And the market's much deeper than what most people think. Because of that, that is the dialogue. How's the best way to put this? That is the dialogue for those that are trying to say the market's just so narrow it could roll over any minute. You got to have that to get to that point. So just completing this, coming back here, is that what I'm seeing is there's still a rotation. There's still forward-looking returns coming in, and that is right now. I'll just quote this, and then we'll move on and we'll get into the technical and looking at these long-term charts. But right now, if I look at the weekly, right now we are about 54% of the duration of the holding period of all of those 9,312 stocks that are long right now. Approximately 55, I'll just round it up, 55% of the duration of the average holding of these signals are what we've realized. We don't get to 100% on these. We'll get into probably higher 68 to 72%. So if we look forward on everything, let me just bring that up. I need to point this out. As we look forward here, what you'll see is down below is the only one, conglomerates, is the one that's extended, but we're only 71 days into the consumer non-cyclical. We're 152 days of 305. I'll highlight this. This is what the typical holding is, 305. These are trading days, not calendar days. So that's a year and a half. This one's 231. That's about a year. All of these are approximately anywhere from 50 to maybe as much as 70% of the duration being held. So the whole point here is that what we're going to see is there's still forward expectations here in the database. And like I said, I continue to look at this the intermediate database, looking for some sort of rotation, and we don't get it. We're seeing a rotation, but we're not seeing any liquidation and seeing the degradation of the percent bullish. Okay, so let's get into the meat of what we're going to be doing today. So we'll start off with the S&P. This is about as good a place to start it anywhere. There's a couple things going on here. This is the quarterly or the 3-month chart. The chart we're looking at right now, I roll it back a little bit. This goes all the way on the left-hand side of the screen is 1949. So let's just zoom in on the current action. It's interesting. Right over here was the 2000 high on the right-hand side, and the left-hand side of the screen, and then we see this monster rally that's been unfolding. And we've seen a couple things here, folks, and I think everybody knows this, but I'll try to say the quiet part out loud. We've seen just the markets getting pumped time after time after adding liquidity into the market, the leverage of everything. We've financed this whole thing. And one of the elements that everybody seems to also be targeted on is of course, the debt going into 34 plus trillion, all of those things. And I'm still convinced, and it's not that I love AI, I believe in what it's about to do, and it's not going to start until 25 and 26. Hopefully we'll have a new administration to run us forward on this thing. But as far as the trends go, this chart that I have up here right now, if you can see my cursor, the cursor is right now, that is 2028. So these trends that are being projected are likely to continue on. And I absolutely believe that what will happen is that we'll see GDP start to expand, and that will be the driver of the markets going higher. And then ultimately, I also believe that the high debt ratios will start to change, even though the government's going to spend probably in a continuing path that they're on. I still look back to my 2024 outlook that I did on Substack. If you go back, if you sign up for Substack, what you'll do is you can go back, even if you have just a free version, because I released that out as a free. What you can do there is you can go back and look at what I was saying for 2024. And what I was saying in general is that 2024 would be like 2023. We'd have back-to-back positive years, which we've not, if you go back all the way from 2020 in the most recent, we've been oscillating back and forth. Everybody thought after recovering 2020, we saw everything start to roll over in 22, and 23 was good, and so everybody was expecting this year to be a negative year. My expectation was the opposite, would be back-to-back positive years. And one of the things that I continue to see a lot is a lot of the community I still service at some level, not like the old days, but a lot of advisors and managers are just flat missing out on this market. And I keep telling you, when you have 20+% returns and you're not at least returning 10, 15 plus percent in that segment of the markets, then you've got a lot of trouble. And I think a lot of folks are very frustrated by what's going on. I see all the people, I'll mention like a Tesla crowd, all that meme crowd. I view Tesla as a meme stock, but they all, if I just have 300, it'll turn into 1 million. All they had to do is buy not even $300 of NVIDIA, and they'd already have 1.2 million. This type of thinking of investing is out there so that it keeps, I guess, the markets in a more stable mode, just because of the hodlers out there that are in Bitcoin and everybody around, right? So this is, I acknowledge the millennials as the largest crowd there is out there. There's still a lot of institutional money, but we've seen the meme stocks, we've seen these things blow up. Just look what happened in the last few weeks with Tesla, so that's a good example. I mean, this is a company that sold 5 million cars in their entire life, and Toyota does 10 million a year, and somehow are valued like they are. I know it's an AI company, it's a whole lot of stuff. But the point is that this is the kind of mentality and psychology that is behind the market. So I acknowledge that, and that's something that you have to understand. The markets don't stay the same. I've been doing this for 44 years. What we talked about in the 80s is not what we talked about in the 90s, and it's not what we talked about after the dot-com and then 2008. A lot of years have went by, decades have went by, and I've been through all of these iterations, and I'm usually pretty good about picking up on the new trends and what's going on as far as what's driving these trends. And I know everybody's tied into this AI bubble. That's why we'll cover NVIDIA here shortly. But let's go back to this long-term chart here. What we're seeing is a very expanded version. I remember talking, there's a target here up at the top where my cursor is right now at 61.25. Let me bring this back in here a little bit. So the 61.18 is this first objective up here. If we look at the market grid for this quarter, for Q3, the market grid is suggesting around 60.74 would be RTX. But this is something else I'll show you here in a minute on the monthly. It seemed ridiculous back when we were 5,000, not that long ago, a few months ago, where talking about 5,600 seemed somewhat ridiculous, but it wasn't, because we're trading there as we speak, right? We're at right now 55.67. We're a minute away from being at 5,600 plus. And we'll go through this just a bit more, but let's bring in the perspective of the PPMs and what this is being projected. And we're still seeing the possibility, and this is interesting to me, of the markets continuing higher into the end of the year, actually. And I'll kind of tie some things together here for a second, is that I believe that what we're likely to see is the Fed I don't think will lower rates in September like the futures are starting to suggest. That could happen. That's okay. I don't think it matters. But I think we see a move probably at the end of the year, maybe even into the first meeting into 2025. I don't think the Fed wants to be seen as political, even though they are. But I don't think they're going to make any moves on the downside on yields. But this particular, that's what all the PPMs are telling us. The forecast is suggesting more of a sideways broad range. But I think we could easily, in this quarter, into the election, we could print up in toward this 56,000 handle, 6,100 handle. This is a very, very probable. Not saying it's possible and probable. It's not guaranteed, but it does look to me that the ranges that we're looking at here, at worst case, is probably a range of 53 to maybe as high as 58 to 61 for the quarter. So this is right now, we're just in the second month of the third quarter. I don't think it extends above that. I think after this quarter, we'll see this chart, we'll see the market grid turn down, and that will start to indicate some sort of top. So let me try to I want to spend a fair amount of time here because I have the best data on the S&P. The NASDAQ and others, the data is not as good as it is here. So we'll do most of the analysis, and you can assume what I'm telling you here is, and I'll carry it through because we're going to go through NASDAQ. We'll cover the Russell the whole bit. So let's see how I'm doing. 22 minutes in. So I'm thinking I'll be able to finish this within an hour. If it takes longer, I'll do it. Okay. As I know this week is very chopped up for me as far as I'm not, like I've been telling you, I've been trying to do Sunday night lives, and that last week I did a posted video. This week we're doing live. So, but let's carry this a bit further here, okay? Let's go into a monthly analysis, and you folks you're gonna see something very interesting. Yeah, somebody, before I move on, I do want to address this. What are my settings for the 3-month chart? Henry, I'll go ahead and do that. So let's just go through that. Right now, the Fibonacci projection tool is just standard. It's just how it comes out of the box and all the defaults. I think with this data, yeah, so all of the algos are set to the coefficient 150, future bars for 50, and they're standard as well. So everything is, for those of you that have the indicators, that everything is standardized there from that standpoint. There's no special settings or anything. And on the red dots, I have, let me show you that because people keep asking me how I'm doing that. So what I brought up here is what you'll see is, what I do is I go into the WTARs and I set them to a period of 1. the color of the SMA, I turn it to black. I like to use the black background. I don't want to see the one period, what basically is a closing one period moving average, which is not going to be very useful. But here on the auto regressions, I'm just looking forward 6 periods. I left you have to have enough data. You may have to change this to 50. I found if you change the coefficient under 50, it doesn't work as well. The forecast changes fairly substantially. You need enough of the look back to develop the coefficient. Future bars are 12. The thickness is 6 is what I had up there. And then we just left the past bars increment model coefficient at 3. Okay, so good question there, Henry. I appreciate that. Real quick, I'll answer Green Garden Capital. Yeah, so so these settings are typical for that. And if you want to find out, those of you that don't have the indicators, if you go to kendallreport.com/indicators, somebody said there was a great comment on our Discord. I think it was over the weekend. I solicited the comment because I wanted to know more from somebody, but they said it what I experience all the time. And because what I'm going to show you on the monthly chart, this is all going to tie together. So thanks for your patience here. But what is going to happen is we get one of those inverted V. You probably saw that corny song I put out the other day. It was just kind of fun, the inverted V, but it is so powerful. And these V patterns that I'm going to show you on the monthly where these things happen, and they're very powerful, and you want to definitely pay attention. So it is like getting a forecast, and what's being forecasted here on the 3-month is actually that there's a V coming up at the end of the year, and it makes sense. Let's go to the monthly. Let me go off screen. So monthly this is the final, we'll call it the peak value for momentum in this trend that's been forecasted. We'll see how, once we get to the end of this month, we're going to watch and see if this V, let me draw these in so you see them, and this will help you with some of the analysis as well. So here's the V right here. We've already got one coming in here, but this is monthly. And you see the algos, though. It's interesting that the algo is not currently forecasting. We're looking at more of a flat period coming into this rising moving average. So let me clean this up so we can. So here you can see that there's a little bit of positive tone, but here's the other thing that's here. This Fibonacci forecast came in for 52.19, 56.43, and 59.08. These are the green dots here where my cursor is moving around. That was the target. It seemed back in February, that seemed like a ridiculous statement to even mention those. And as you know, this is my monthly. As soon as I get all the data for the first of the month, I try to do these long-term forecasts so you can get a pretty decent idea of what's likely to go on in these patterns as far as what the Fibonacci targets are going. But we are getting very close. If we look at the monthly, two things. We got 56.45, and we also want to bring up the market grid. Let me move that over so you can see that. Right now you can't see it. So the market grid's over on the far right. You'll see for a monthly, we got 56.15, which almost matches perfect with that fib target. And then we have 56.97, 57.60. And of course, on that quarterly chart I just showed you, we have the 6,100. So I think there's still some possibilities for some kind of crazy spike. Is it going to be NVIDIA or something like that? I'm not sure. So yeah, so I'll probably do that. I've got a lot of trolls hanging around me on the Tesla. So we'll do a Tesla analysis as well as NVIDIA. Okay, so what I'll do is I'll do this. I'm going to go NASDAQ. Let's just go ahead and do the Russell, and then in between that we'll do the stocks in the middle of this thing and go on. So I'm doing well. I got 30 minutes so far. So thanks again, everyone, for showing up here. So let's go ahead but you can see the algos are suggesting a bit of a flat. We're seeing peak momentum come in. It doesn't mean the fact that we are seeing the volume peak. These inverted V's work way, way better on the short-term hourly chart. It's killer. I know people that have paid attention that it is a crazy, usually get 1 to 2 hours of a move. And on some of these days, like we have coming this week, there's probably some great hourly trades coming on the S&P or your index of choice. It could be an individual stock. Just kind of validate these things. And I need to probably do just a video on the V trade, we'll call it. I think I did one briefly, but I need to dig into that because it's become one of the arsenals that I use all the time. And I know a lot of folks have done that. So let's take a look at the monthly charts. You can see also are starting to, it looks like a big decline coming. If you look at the PPMs, all that's happening is this big momentum that is built up. You could argue that there's a divergence high here on PPM 1, and maybe we start the roll. But if you look at what's going on with the 10-month moving average, it's currently just now at 5,000. Let me see what it's changing. It's doing right now about 130 handles per month. So as we go through the months, it'll be 51, 50. Let's just go 51 and a half, and then it'll be 53. So this monthly support, by the time we get into September, we're going to tie it all together. Everything I just told you about the forward-looking database and looking at the 3-month, everything looks like we're going to follow this angle of attack of the 10-month moving average, and that's going to be the big support number. Now it's way out of play right now. Like I said, it's at 5,000. That's not even has a 10% probability of being hit. But the point is that it will be in play as we come into September, October, November. As we come into the election, we're going to see that angle of attack come into play, and that's going to be a key number. Whether we get some sort of retracement or not from that level, we'll have to see. Right now, the algos are suggesting we got peak values coming in as far as the trends go. That doesn't necessarily mean a rollover. What it probably means is a consolidation, especially as high as these numbers are. You get really big numbers when you look at the weekly and monthly charts, and especially when you get out into the quarterly. So we're in what I would call a deep, strong trend that is likely to continue. We're just looking at the quarterly. It's the algos are suggesting that into year end, and I think that's fairly realistic. I don't know that I don't know what the impetus would be for us to get any kind of negative push. And just to add this in, this is one of those things that if you didn't watch the video for the 30 minutes, you'll never know I said this. But one of the things is no one talks about, what if we actually did get into where the Israeli situation came under control, we had Ukraine get under control, and there were positive events that happened from that standpoint. what would that do to this market? Would that be a positive or a negative? I think it would be positive, and I'm not sure. I flash back. Listen, I'm an old guy. I remember in 1980 when Ronald Reagan was coming in. And matter of fact, one of my long-term customers was the youngest, the 18-year-old Marine that was actually in the hostage situation in Iran. And so I've had some background into this pretty in depth. But Reagan told him, said, listen, you let our guys go or we're coming to get them. And they were let go like within hours of the election. So we could have a lot of things change very quickly depending on the outcome of the election and those things. So there's a lot of triggers. And but it looks to me, if I had to just summarize here, then we're going to move on to NASDAQ and we'll get down the rest of this trail pretty quick. But if I had to summarize this, it's really looking like probably some peak into year end, and then maybe finally we get some, I guess, backfilling. There used to be a guy that used to come on, I think it was CNBC, he used to always say the markets are pausing to refresh. The whole concept of these minor corrections are really healthy to be able to get the excesses out of the ownership of these stocks and everything that's driving. So maybe that's what happens. But everything is pointing toward fourth quarter. We got the classic October low coming in. Everybody looks at October because of the crash and some other things that happen as a negative month, but for the most part, we actually see more positives than negatives out of that month. It's a turnaround. That's what happened last year. So we're coming into that annual cycle as well. All right, I think I got all that out. Let's go through the NASDAQ. We'll go NASDAQ, Russell, and then we'll do NVIDIA and Tesla. Let's do those two. We could probably do Apple the whole bit. I mean, we could do a couple hours here, but we're not going to do that. Okay, so we'll do those two. All right, let's move on. All right, so here we go. This monthly chart, we look back. Let's go back to, I've got my cursor right here on October. Let's pull this up. This bar right here is October of last year. It was right on that 10. This is a monthly NASDAQ. Right on that 10-month chart, on that 10-month average. And look at it, just rocketed off of there. We tried to come back to it, and we've got this other leg. I probably won't do this right now, but this is somewhat of an unorthodox type pattern. The way that this thing's set up, the volatility is huge from that standpoint. Won't forget Bitcoin. It'll be last as always. But this pattern here is very similar. They usually are to what we're seeing in the S&P. Look at this angle of attack. It's huge. We're looking at December of this year with the 10-month moving average being around 19,632. So it's a vertical move. My expectation is, let me draw in something here. This won't take that long. We're going to stick to long-term only. If you want to know my macro or micro for this week coming, then sign up for the newsletter. I'll do that later tonight. So let's take a look at this this pattern here, and this is going to be my expectation, is that we probably see the market grid do something like this over the months, and we'll trade within these ranges, but we'll stay above this 10-period moving average as it is right now. So we're going to stay, here's the 10, I'll just draw it through. We're going to stay above this in this pattern. So this pattern here will continue to evolve. We'll probably see prints of new highs, all of that. That is what's being forecasted from that standpoint. So when we look at the PPMs down below, like I said, I'm just going to show you how to do a setting here for those of you. There's quite a few of you that have the indicators. Let me just show you. Like this is set for 150, and NASDAQ doesn't have enough there, but you can see I've got this set up. So we're getting enough here, but on the PPMs, once again, we're looking at getting this peak value, and this is a little bit different configuration than is on the, let's do this one too, and I'll put these back here. I think I'm gonna need them set to here. So we're gonna set all three of these back to 50, look back on the coefficient, okay? So this is the configuration. We're seeing peak values, but even if I come over here, it's not until around January or February where we start to cross first, second derivatives, where we're going to be talking about challenging these moving averages. I think they'll stay well into play right into November, December, and maybe the Fed will get their wish here. That wish is that we start to see further flattening from an employment standpoint. If you know, those of you that have the Substack, I was talking about the employment numbers that came out last Friday, that we would see employment tick up. I still have a 4.2 target. It was expected to be flat, and everybody kind of went to 4.1. I think there's a few more upticks there, and I'll cover that as it gets more appropriate. So I'll answer a quick question here. Excuse me. When you on the coefficient, what I'm doing is I'm double clicking on the PPM, just on a solid line that brings up, or you can go over to the list over on the left-hand side and just go to settings. And I set these to 50 on model coefficients and left everything else alone. So if there's not enough data, that's something that you have to do just to make sure you're getting forecasts. And when you start to look out, I've got them set for 50 bars, mainly because it looks cool. And then while we go forward, I'm probably 3 or 4 of the projections that you're getting are reasonably accurate, and they will reforecast as we see real data come in and the look back comes in. But for the most part, that next 2 or 3 bars is really good. And I have always told everybody, and this was been a joke, but it's now become somewhat of a reality, is what if you could see the expectations for the next 1 or 2 bars? Now, this case, we're looking at monthly, but like I said, you get into hourly and daily and even the weekly, you'll see some amazing patterns there. So let's cover this just a little bit further. So we are seeing peak values coming in next month here on NASDAQ, so July. And I'm flashing back to my own work that I've talked to you folks about. I've always know that Bob's having some issues mentally when I don't recall what I said 4 or 5 months ago. I have a crazy cool memory, but what I'm recalling is I was talking back earlier this year in February and March that we would see at least this rally last into July, and we're at July. So I need to, I've got this little voice in the top of my head, like, don't forget, this was the original forecast. And oftentimes, as you folks know, your very first analysis is the best one. And where we get in trouble is sometimes when we start to change things too much too often. And so keeping that context, it looks to me that we're going to see exactly this forecast play out at least into the September, October. This is an update. We need to watch what happens in the month of July, and I'll be on top of that. But let's break this down. We didn't go to weekly on the S&P. Let's go to weekly here. And weekly is starting to suggest as well, we'll just bring this up, that we're getting pretty close to peak values. Now, we started off, it looks like we have on a weekly basis, we're down a little bit here as the markets are opening. But if we look at the range for this week, we're looking at R1, R2, 20,765, 20,967. Support is at 20,475, 20,313. And you see the algos are at least predicting that the market's going to flatten out and come into this 10-pair moving average. And it's forecasting, but these three bars here are suggesting that we could get into a consolidation range, but I think we still print a new high. We probably go into those numbers I just mentioned as resistance. We look at the algos, you can see we've hit peak values, at least on PPM1. PPM2 still at a 0.78. It's at 0.78, and what we're looking at is still a very strong underlying trend. So everything in the angle of attack, everything's okay. We'll bring up the daily real quick. And this was what I also found interesting. And they look the same on the S&P. So if you're watching through this video, just kind of reference back to the S&P and get that reference. But you can see we're still being forecasted for the next 3 or 4 days. This is a daily forecast now. We're still looking for this thing to come back up in here. And so there is still a higher forecast. See, clearly the angle of attack is still very positive, and the PPMs are basically in a what I call a trend maintenance mode, where PPM 1 is actually staying right around 0.25, 0.30, which is trend mode. So all you need to know is that when you're in trend mode, there's a 60% probability that you'll remain above the 10-period moving average. So any dip that you see down to the 10, therefore, then is a buy signal. All right, so we went all the way on NASDAQ. Let's go to Russell here. Hang on, I'm adjusting some data. I hate the Russell data. Let me just look back. Yeah, we just don't have good solid data to go too far back on the Russell. What's interesting, this will pique some interest on some folks. If we go to the quarterly, we're looking at these crazy projections on the upside, the 3,000 plus on the Russell. And that would make a lot of folks happy, I think. But let's come back to reality and just go to the monthly. We're seeing basically the opposite here, is that we're also getting into peak values. We just can't get out. There's way too many zombie companies in here. And I will tell you, I'm working on a project right now to do some ETF hacking on some of these big indexes, and I've already got the S&P done, and it's I'm working on some of the others, including the Russell, because there's some great companies within the Russell, but from an index standpoint, this is just like the worst index to get to move. And I know, I think Drunken Miller or one of these guys are, touting IWM. And I can put that up here just for fun. And actually, that's actually good because I'm actually getting calcs out of this here. Let me go here. Not enough data there for that. But let's go back to the monthly. Everything's being projected to peak and actually turn negative. So, yeah, I hear, I was promoting this same trade a while back when if we go back to last October, the index did fairly well and got up. But if I break this down just a little bit more, this is the sad part of this index, as we're trading slightly above where we were in 22, but we still haven't even got back to 21 levels, right? And there's just, if you look at the algos and the projections that are coming on here, there's just nowhere to go. I'm not saying that there aren't good stocks that are inside of this index. I'm saying this index is just it's a zombie, and there's no way out of it. There's still a lot of even though WaveTech's long the financial sector, there's some really good stocks in there. I've been really digging through that. I'm working on this hack on this right now, trying to come up with one of the things I do in these ETF hacking is you want to find consistent analysis that I can walk forward, and that's what I'm working on right now. It's very easy in the S&P and some of the other indexes. But this one's a tough one, folks. I'm telling you, it trades like this because of the constituent list. It's just a list of a lot of companies that are struggling, especially refinancings and things that are coming up. And really in 25 and 26 for this group is really pretty restrictive. And I've been a proponent of, just because I've been around so long, that looking for the rotation into the small caps, like that's the next phase of a bull market. You get all the big, the large cap, mid caps do better. And then finally, when people are starting to take profits on the large cap, then you get a rotation into the small caps. And that's how this works almost always for most of my career. And it may still work that way. But right now, we haven't gotten the rotation out of these other indices. And this is the problem. Once we maybe do get what was being forecasted, let's say we come into 25 and we get a rotation. I didn't go through it tonight, but I did on a video, and it's still valid. I believe there's a video on the channel. If you go back and watch, I think it says something about algos are forecasting interest rates to zero. And it was a bit of an exaggeration. But if you go look at that, I know the analysis that I did on that video is worthy of looking through the interest rate analysis that I did and what the algos are predicting. And I put out a pretty decent scenario. There is one of the Substack, I think, around the same time. So if you find the video on the channel, you should be able to, if you're on Substack, you should be able to go back on the Substack reports and actually see me what I was saying there in writing on this scenario as well. And I know there was a number of both yield curve analysis, all that stuff. Yeah, so where am I at now? 53 minutes, folks. We got to go longer. I'm still on the Russell. We got a long ways to go. So give me a thumbs up, or yeah, let's keep going beyond an hour if you guys are in. Sorry, there's just so much to talk about, and I know I'm not going to get everything out. So, yeah, just, let me know. Give me a thumbs up. I'll keep it rolling here. But so that's that. So let's go on and let's start with NVIDIA next. Here's the, okay, I'll keep going. You guys keep telling me though. Gotta root me on. So here's the NVIDIA chart with the algos up here. Now I don't have. Let me look at something here. See if I can get this to work. Yeah. So let's change this to 50. Yeah. So this is the forecast. This is a monthly graph. Okay, we'll go through the PPMs. Is suggesting that we're getting to peak values here. We did not. It's interesting. This is monthly. We almost got an RTX sell signal, but here's what I think is going to happen. I'm going to draw this in, and then we'll do Tesla, and then we'll move on. This is what should happen here with whenever we get, this is what I call that big expansion bubble that happens. So this 10-period moving average rising in here is going to be substantial. And I'm just trying to, I'll get some numbers. When I'm on this drawing tool, I can't get the numbers. But this is what my expectations is for as far as the trading range that we start to trade in, and I'll define this here shortly along this moving average line. But this is probably what we end up doing. Let me take some of this out. So this is going to be your what I'm going to call the demand line for NVIDIA, and well, I'll give you some numbers here in a minute, so bear with me. So, but this is most likely one of these what I call volatility bubbles. You can almost see this one here. We go through a correction phase. There's one right here where you get expanded, and then the market grid starts to come in, and then you finally get a V out of here. So let's go and take this stuff off and take a look at what, now this is monthly. You can see momentum, everything's hitting peak values. This will give you a little better perspective. It looks like we go sideways into that range. If we look at for this month of July, over here on the far right, you're looking, let's take a look. Along this line here is where we were at. This is around 103 or so. So we actually probably take back everything after the split. We start to come back in here. I think I was projecting for 1,300 to 1,500. We made it to 140, and then we get that big reversal day. So let's back out of this a little bit. So now we can see the reversal that happened up here. This was the big reversal from 140. Now we're getting sideways. This will fine tune it a little bit. Ultimately, we probably hit 120-ish, maybe a 115, and we get this consolidation. I suspect after last week that what we'll get here on this on the market grid is you're probably going to see that turn up, and you'll start to see this happen here, and you'll get into some kind of pattern like this. Maybe it's a dragon head, and then down the road, you bolt up again. So there is an argument, by the way, let me clear it, that this is 1, 2, wave 3, wave 4, and extended wave 5, where wave 5 was the strongest. Then what you get is A, B, C, probably back into this level here. I can't tell you the value here, but this would be, and that's basically what the algos are suggesting, that we get, there's some kind of little echo bounce here. And let me just draw this in real quick. Yeah, so you probably get little echo bounce and then back into this moving average, and you flow around here. Maybe you get a big ABC, but it's probably time for consolidation from that standpoint. Weekly chart we're looking at, okay? We'll do it daily. You can see even daily is starting to suggest around 120. We printed up here back to around 129. That was probably it. We get the reversal. Sideways range, we got good support here on the moving averages. The daily PPM1 is trying to turn up. You still got huge momentum underneath this market yet, so you're going to bounce but around these levels here. If I blow this back up, you should hold around this 1021 period moving averages, which right now are 124, 125. If we break below that, then you come down to the lower end of the range. I don't have the updated market grid for the moment. All right, let's do a quick Tesla run. So Tesla was being forecasted up. This is daily. It looks like we're going to flatline or try to flatline. Let's go weekly. Still, look at this curve that's being projected here. We got over the 200-week moving average. I saw some articles around that a bunch of hedge funds got short and got caught again. And, you know, one of the things that I will say for those of you millennial traders, you guys are really good at putting market orders in, and you just bid these markets, and everybody, it's the FOMO, everybody's stampedes in, and those stampedes are fueled, and everybody, this was a very interesting week last week from that standpoint. I'm going to bring up, I'm going to bring right now VPM up. And I'm going to show you a quick trade here on weekly. We got a sell signal. Let me go here first. 177.92 was a buy. And we traded as high as 251, up 41% on this trade out of nowhere. I believe Daily caught this as well. Yeah, Daily bought at 186 a little later and caught this move. And it's interesting. I'm going to back up one here. If we look at the market overview here, let's just go to the trade profile. I'll bring this down so you can see it. But the trade profile suggests that we're going to around the typical holding period here is a current trade is 13 days, 152. We've already, the target for this trade is 310. So there's another $50 in here. If it comes above, much more above this number, you're going to watch this trade very quickly, because we'll probably see it start to flatten out and maybe do some retracement. Those that are gap traders, there's several gaps on the upside as we went here. You can see there's this was basically a runaway gap here. And so algos are suggesting what's going on. We got a RTX sell signal a couple of days ago, so we should see market grid turn down. We should come into this range. This 10-period moving average will take about 5 to 6 days to actually get up into this range over here around 230. So we're probably looking at somewhere around 230, 222 from that standpoint. I think there's some numbers here on, yeah, there's nothing to guide off. We got on a weekly basis, we did get an RTX sell in a big way. So we should, maybe there's a little more follow through, but we should start to go sideways into these moving averages. and it's going to take a little bit here to turn this around. So just to summarize, that this thing just blew up, and which is great if you own it. It's awesome. But the question is, do we continue to own it? And my thoughts here, as we bring in some of this viewpoint of a little bit longer, I'm going to go to a monthly chart here. I just want you to see this. The algos were, this is what happens when the algos are suggesting up to around this 280 plus, and then a flattening back into the moving averages. Let me everybody, it's interesting. If you say something about a stock, there's a group of you out there that want to always go, you said this 6 weeks ago, you said this 3 months ago, now it's not. I just say grow up, figure out how the markets work, because what happens here is everything started to update. We started getting buy signals on the weekly models. Everything started to come into play. So those forecasts get thrown away. But it's always, there's a, especially on Twitter, and anytime I post anything around Tesla, it's a gotcha. We got you now. You were wrong. So, yeah. Anyway, but these type of patterns, they evolve, and this is everything that we've done in this stream tonight, now over an hour, is what we've talked about is these forecasts, and these forecasts get updated as we get actual real data, right? So I keep telling you, they're good for 1 to 2, maybe 3 bars in the future. This is a monthly bar, so all of a sudden, maybe we hover right along this 40-period moving average. What is that number? That number is 241. So enough on these stocks. Let's go ahead, and what I'm going to do next is we're going to cover interest rates just briefly, and then I want to get into, we'll do gold and Bitcoin, okay? Yeah, and Todd's right. There's no absolute. Of course there's not. In 44 years, I think I figured that much out, right? So you trade the probabilities, and you make sure when you see these trade setups, you pay attention. Things change. When they change, you should change. So that's the beauty of everything in life, is everything's a probability, right? Okay, so let's go ahead and let's get into, like I said, let's go ahead and cover interest rates. That'll take just a minute. I just want to update that. All right, so here we are, a monthly chart, sort of interesting. We're really locked in this upper band. This is the 10-year. There are some Fibonacci targets above here that are still valid. This is monthly. 552, 620, and 660 way up here. I always say never discredit these things, because if you recall, we had these big numbers we talked about, up to 760, as high as 820. I don't think we see this. I think we do stay above this 21-week moving average, or month moving average. This is monthly. That number is at 406. And as we break it down and we go into the weekly, you'll see there's some downside. And I think what we'll see here, let me expand this a little bit. I think what we see here looks like some forecasting of down move here on a weekly, but we should start to hit the bottom end. I think the market grid turns down when we get an update here, and that will put us down down around levels I've been talking about. Around 433 is a big pivot number. So we get below there, all of a sudden 420, 415, 402 is being forecasted. We're doing gold and then Bitcoin. So we'll cover everything. We'll keep going here. So hang on there. Yeah, I see we got a Tesla fan. So, yeah, Europe and, Europe's in worse position to power electric cars than we are. We're pretty bad. I happen to live in the greenest place on the planet, which is Phoenix, Arizona. It's hot as crap here, but guess what? We're nuclear and hydro-powered. Don't have any fossil, mineral, hydrocarbons, nothing's burning to make electricity here. We got big solar, so it's not there. Yeah, so boy, we could do a whole show on just on housing. Henry's asking. I think the reason, I don't think there's going to be much of an increase. Housing's another story. I can't go there right now, Henry. I'm sorry. I'll try to, if you get Substack, I'll try to bring that up because there's some things going on there I think is interesting. So rates look like they're probably going to stay stable. I'm going to go 415 to 440 yet on the yields. And ultimately, maybe we can print down closer to 410, 4%. The algos are suggesting that, but I think more than likely we stay right within that 420, 440, maybe a couple prints down lower. It's not going to be enough to save the housing market at the moment. The only thing saving the housing market is the fact that inventory. All right, so let's move on. Let's do we'll do gold. Yeah, gold has been looking interesting. If you recall, we've got what I call the dragon head set up here. Forecaster for higher. We still have valid fib targets number. We hit fib target 2 already. The upper end of the fib target is up here around is 25, 28 on the upside. It does look like this was a pretty good positive mode. Thought we would go sideways. If you folks recall, this was the forecast. This is the weekly chart. If we go to monthly here, there's a bit higher projections. Fib target 2 here is at the 2469, 2579 is upper levels. I think we stay within the market grid here on the monthly, which is going to suggest, if you look over on the far right hand side, you'll see these numbers. We're looking at R2, R1, 2376, 2418. And so we're probably looking 2418, maybe a retest of this high up here, but I don't think, most likely we'll see a consolidation. And the same pattern I've been drawing in for you on a lot of these longer term charts are likely to happen here as well, which is we'll get this market grid to kind of focus around. Markets will stay within these areas, stay above this 10-month moving average, and then we'll see everything start to just trade within this range. Algos are even projecting a move down to the 10-month and then back down. But by the way, if I get rid of this, when we look at that, that is November. And what did I just talk about? I just talked about that interest rates would start to drop. I was talking about that just shortly, that probably some sort of rates come in. I probably, like I said, go watch that video that I did. I think it is titled Interest Rates, Algos are projecting interest rates to zero or something like that. Watch that video, because that analysis tells you where the peak is going to come in, and there's going to be steady 0.25% drops. I also talk about what I think is going to happen to the yield curve and a whole lot of other things. It's still a very valid video, and that analysis has not changed. So I'll direct you back. I think it was probably, I don't know, it was maybe 3 or 4 weeks ago. It was in the last month that I covered that. So make sure you go and watch that. But gold looks like it's going to stay in this range that we're looking at here. All right. Here's what some of you have been waiting for. All right, I changed charts because I didn't want to have any heart attacks out there. So I've been talking about this for a while. Let me bring up, I would say going back, my Substack the other night I thought was interesting. Let me come up for a minute. I believe a whole lot of people got involved in Bitcoin, the ETFs, the whole Bitcoin, I'm doing the Bitcoin community was screaming the ETFs legitimize us. And what they did is they now got a whole bunch of nasty players and these ETF managers, and they got a whole bunch of amateurs. And they got a whole, I basically said the ETFs got suckered everybody in. Now they're slaughtering them. And I think this is going to get really, really ugly. And I'll show you some forecasts. I've been talking about it. Most likely we take back all of the pre-halving event, right? All of that away. And it's going to, how ugly can it get? I don't know. I think there's a big unwind. I think, matter of fact, the ETFs set volume records for ETFs ever and ever, right? No one's ever seen that kind of volume. So that tells you, I think a lot of guys, I've worked with the investment community for years. I think a lot of guys are telling their customers, oh, now we can get into Bitcoin, we'll buy some ETFs. I think all of those guys are getting hit hard. And anyway, let's get into the analysis. So here is the weekly chart. Weekly is, there is some hope on a short-term basis. Let me just bring this up so we can see this. There we go. Absolute reversal bar. This is what's going to, in the short term, set this up. And I mentioned this on the Substack, I believe, on Friday's report, is that this is right here, this 40-period moving average is what's going to save it. We have a declining 10, a rising 40, okay? And what that tells us is we probably get wedged. It's interesting that even the algos are agreeing with my analysis, is that we're going to get wedged in here, and market's going to trade in this range. It's like 60, let me get to your exact number here. I'll have to get rid of this stuff first. Bear with me. So that range is going to be roughly 55,000. We basically already printed the lows, and we rebound to around 63, 64,000. That's your range. This is a weekly chart, so over the next several weeks. But that range, this is important to understand. The range is condensing, and so you get that downward 10 it's going to be huge resistance. So if I bring back the PPMs, you can see PPM 1, when we came into that rally, PPM 1 was way up at 5.7 whole integers. That's a huge rally. What happened there is we get sideways, we consolidated, and every Bitcoin guy, I'll say this as we go, I see this everywhere. I was equal, my very first research job I was in my mid to late 30s, but I had to actually do a lot of work to get that job and validate that my analysis was good. Now anybody and everybody can set up a YouTube channel and become an expert. And so, you know, be careful. I think I've done a really good job on Bitcoin, but I think you just got a lot of amateurs, guys throwing trend lines out there and just trying to get it. And I realize I'm a moving average guy, right? But what's happening is I've spent the last 38 years roughly being a moving average guy and studying these things and living and breathing and building models and all kinds of things around them. So what I'm telling you here is that these models that I'm going to present to you are suggesting that we're going to see weakness into August. And so I'm going to bring up the scary chart next. And I think that's important to understand. I'll cover probably some of this. So let's go full on. So this is where we are. So those of you who follow my work, you know this, is that if you go in time series, so let's say you started daily, weekly, monthly, and now we're at monthly. Okay, if you go, the 40-day moving average is somewhat equal to the 10-week moving average. Okay, so then we go to, on the weekly chart, the 40-week is similar to the 10-month moving average. Okay, so if I back up here just a second, the weekly value right now, and let me bring it up so we'll get exact values. The weekly value is at the moment 52,902. Now let's go to monthly and let's look at the 10-month. 10-month 53,534. So the reason way back when Bill and I were looking at moving averages, we realized that as we went in time series from daily to weekly to monthly and beyond, is that the slowest average on the previous time series, just going daily, weekly, monthly, was equal to the fastest average on the next time series up. Okay, so quick education. So then when we get to monthly, and this is good, if we look at the angle of attack on this chart, the good news is we're right at support. The bad news is we should be able to bounce. We'll probably stay within that monthly range I just talked about, and then we start to get some challenges. I don't think, this is what I was trying to say, is that it's very possible that we end up back at somewhere between 44 and 31,000. Everybody's going to say, no way. I'm just telling you that all of these things are going to flatten out substantially. I think somewhere between 50 and 44 is likely to be the low on this particular cycle. We'll see what unfolds here as we go forward, but that looks like, to me, and looking at this monthly chart, we should get a bounce out of here. And I think this downward projection that you're seeing on these dots, they dissipate, and I'll just draw in what I think is more realistic as we go forward. And it's basically, we probably bounce out of here, maybe get into some kind of range, just like before. All of these, this is going to take, by the way, this arrow I'm just drawing up here, that's 2025. Okay, here's 26. So most likely what's going to happen, I know Kathy Wood and everybody's got these monster numbers on the upside. The whole scenario, the halving event and less. Anyway, it's the opposite of fiat. Get it? All that. I'm not going to try to be a fundamental guy. I'm just going to stick with the quantitative stuff here. But this, what we're talking about here, carries us way into probably June of next year, like a year from now. And you're still going to be consolidating these gains. What we don't want to see, so let me clean this up. What we don't want to see is what we saw before, and this, you get this big rally and you get this crazy volatility, and then you build a base, a higher base than the previous base. And if that were the scenario, then you're looking at something like this over here, and maybe you get a higher base to come in over this level. That's just pure technical stuff. Doesn't have to happen. I'm just saying what you don't really want to see that happen. What we want to see, if it's going to be more of a positive, and instead of trying to build this long-term negative scenario, which I'm not trying to do. So I'm just throwing out some of these things here. What we want to see is this larger pattern just continue to evolve. We want to see these algos flatten out. We want to see these red dots start to turn up. And then you get, some kind of wedge here. If you can get, let me clean this up. The market grid is really good at predicting the ranges, and it's going to most likely, this would be the positive, and this would be the bullish positive, is that we get here, and then down the road we finally get the breakout. But we're looking at, looking at probably a year from now. Could happen sooner, don't know what would cause it. But that is pretty realistic expectation. I think there's going to be, if you're trading this thing, there's a lot in there. If you're a hodler, then you are. That's who you are. So you're going to be talking about this stuff in 2026, 27, and maybe not even seeing a new high yet. Maybe there's something. I guess I will say that I guess maintain my right to change my mind. But as things are right now, we're in this really monster consolidation. The past times, this is my point, the past times that we've seen this, we did not have a consolidation. We had collapses down to the base, a slightly stepped up base. We went from 2020 to 22 with this run, and then we've made the new high, and almost like before, the second we made the new high, the reversal came. We just can't follow through, and it's probably appropriate. Okay, and now that we've got, let me just come back up here. Now that we've got all of these ETF players in there, we got a whole bunch of folks caught, got their foot in the door and didn't get it out in time. And so now we'll have to consolidate all of this craziness. And my hope as far as a bullish scenario goes is that we do maintain this upward slope, and we ultimately form some kind of other formation that would suggest that the next level consolidation is much higher. Like I said, the last one after we collapsed was higher, but this one needs to be much higher on a relative basis, because then you're just looking like you have an EKG from that standpoint. So yeah, I'm just seeing what Floyd's saying here. Consider Kathy, expert in bull markets. Yeah, by far the worst portfolio manager I've ever seen in my life, no doubt. The bigger the base, Jason's saying the bigger the base, the higher the space. Not necessarily. I could show you a million examples where that's not the case. But hey, listen, I would say, I don't know, maybe you guys would argue, but I think I have been absolutely stellar and calling Bitcoin and done a really good job. And anybody that's paid attention should have made a lot of money. And all I'm saying right now is that we're in that consolidation phase. We do have momentum. We have right where we're sitting right now, this 50, 55, 54 level. Got to hold. What's the last 55.16? Is that the right number? Hang on. No, yeah, 55.16. So we have to hold these levels. Anyway, folks, hour 30. Thank you so much. I had no idea we'd get into that long of a deal, but we did. Yeah, I don't know. Listen, I'm not an expert on this. People are asking me questions. About fundamentals. So here's the point. I don't know I'm not a fundamental analyst, especially on Bitcoin. I guess there's fundamentals around it. I just get worried when too many people start talking fundamentals, whether it's debt crisis and all those things. I always tell everybody if they've got a big scenario, like remember the scenario, we didn't cover it tonight, but I'll just kind of continue on for a minute, is that we really the U.S. dollar is supposed to collapse because supposedly Saudi was ditzing the dollar. They have been taking oil payments in other currencies forever. That's just the way it is. It's never been any different. The petrodollar, I did a deal, I think the last one I did, the petrodollar scam. A dollar still going to maintain reasonably good presence. I don't see that changing anytime soon. And with Bitcoin here, I just will say that really the way I see it is from a technical standpoint, I guess refreshing the market, having corrections is good, but what we have to watch out for is there's a time when the correction becomes it goes too far and it now damages the potential of the next leg up. And I guess it would be okay if Bitcoin just stayed. I think the issue is in this day of the world of meme stocks and this new investor class that we have is everybody thinks about getting rich on one thing. It really doesn't play out that way. And I think that, I look at the markets much different. I'm just gonna bring up this this chart real quick, and then we'll call it quits. So this chart here is this portfolio I call Elite Innovators. And if you'd have put 100,000 in this, it'd be 1.4 million. And this is from 2013. And this was 10 stocks. This was built in 2018. And this chart is actually a representation of what you can do when you own more than one stock. And you don't have to own one thing to get rich. Warren Buffett didn't do it. I'm not a Buffett fan. You folks have been around for a while, know that. But the point is that stupid diversification with pie charts and trying to own a little bit of everything. One of my mentors used to always say, this is the fastest way to moderate gains and moderate losses. And that's was what the attorneys in the broker-dealer world and a lot of the so-called investment advisors, which are individual salespeople that are managing money for people, they are the ones that I would say that will promote that type of thing. And then once you throw fees on top of the buy and holds, it gets pretty ugly. Anyway, I'm done, folks. I think, let's see here. Hey, Christoph. Yeah, so, yeah, we could go into a lot here. I have checked the M2 growth, actually. And anyway, that's a whole other thing. If you look at M2 growth and you don't look at velocity, then you're wasting your time. Anyway, folks, thanks a lot. I'm now hour 35 going. And good night, everyone. Appreciate you hanging out. We got a fair amount of folks hanging out. So I feel sorry for the folks doing the replay. I know no one has an hour and a half, but that's just how it went. All right, folks, get to Substack. Subscribe to this channel, hit the like button, and we'll talk to you soon. Not sure, probably next week again. I don't think I'll be back during this week, but anything's possible. We'll talk to you later. Take care.